I'm Frank Tomasello of the Institute's Griffith Foundation, alongside Tom Considine of NCOIL. Our organizations enjoy a long-standing collaborative relationship. It's a pleasure to come together with Tom and his team to present this primer program on the fundamentals of risk management and insurance. The session is offered for the benefit of both newly elected officials and for those who desire a refresher. And it's a great way to revisit some foundational concepts in advance of the forthcoming spring meeting of NCOIL. That takes place from April 11th through the 14th in Nashville, Tennessee. In the moments ahead, I'll introduce our presenter, a learned professor of risk management and insurance. But first, Tom, would you care to share a few words?
Sure, Frank. Thanks so much. Great to be with you, and it's great to be with everyone out there today. We really have at NCOIL enjoyed this relationship over the years, frankly, that predates my time at NCOIL and Frank's at Griffith. It's just gone on that long and with that much success. This really will, to reiterate what Frank said, this session today with Professor David Eccles, who's just really fantastic, you're in for a treat, will be really useful as a prep session for our NCOIL Spring National Meeting in Tennessee, in Nashville, as Frank said, April 11th to the 14th. And there's going to be a number of really pressing, important sessions covered, and we hope you don't miss them. And so if you just go to www.ncoil.org, you'll see the registration site for the meeting. And we've already, this meeting has set the all-time record for attendance at a spring meeting. We have nearly 70 legislators and over 300 attendees are already registered. So we hope you'll join us to discuss a whole panoply of interesting topics. We're going to have a session on the affordability and availability of property and casualty insurance, specifically home and auto. And you know it's a hot topic when it's not just being written about in insurance news sources, but in the New York Post, the Wall Street Journal, and mainstream publications like that. Additionally, there's going to be discussions on transparency in two separate areas. So transparency is a big thing. There'll be a model under consideration for transparency in third-party litigation funding that promises to be interesting. And then shifting over to healthcare, there'll also be discussion and a panel discussion on transparency in healthcare costs. 5 years ago, NCOIL passed a model on this topic, and that model is up for readoption, reconsideration this year, and so there'll be a panel discussion on that. Beyond that, there'll be a Griffith session for public policymakers only, and those are always very, very interesting. This one is going to be on reinsurance and how the presence of reinsurance impacts pricing. So we look forward to that as well. And I just can't say enough how much we look forward to the meeting. We look forward to having you there and having Griffith there as always. Thanks so much. Frank, back to you.
Thank you, Tom. Look forward to seeing you in the weeks ahead down in Nashville, Tennessee for the meeting. It's my pleasure now to introduce Dr. David Eccles. He's the P. George Benson Professor in the Department of Insurance, Legal Studies, and Real Estate at the University of Georgia. At UGA, Dr. Eccles teaches in the undergraduate, the MBA, and the PhD programs. He's also the coordinator for the Risk Management and Insurance Internship Program, as well as the graduate coordinator for the Risk Management and Insurance PhD program. David, thank you for being with me and with Tom today. We appreciate the insight and expertise that you'll be sharing with our public policymakers.
Thank you, Frank and Tom. As Frank mentioned, my name is David Eccles. I teach risk management and insurance at the University of Georgia. And today I hope to give a very brief introduction to a few basic risk management and insurance topics. Certainly today is not meant to provide any detailed conversation on risk and insurance. Rather, it's meant only to give you a flavor for some of the programming that's offered by the Griffith Foundation and NCOIL. In particular, the Griffith Foundation will deliver more specific programs on reinsurance and on autonomous vehicles, at least with respect to insurance, at the upcoming NCOIL spring meeting. And as is consistent with the Griffith mission and other Griffith programming, I'd like to point out that my comments today are mentioned with no agenda and are meant to be purely educational and hopefully brief. Insurance is a large industry. It is an industry that has over in the US $1 trillion in premiums in between property and casualty policies, life and health policies, and employs 3 million-ish people. And on top of that, the use of insurance in economic activities and the value of insurance in those activities, cannot be understated. It covers risks that are as simple as us driving our cars as individuals to complex builders risk. And to that end, the breadth and the importance of risk and insurance is so broad, and it would be impossible to cover in the next 20 minutes. So to that end, again, I would encourage you to look and avail yourself of the resources available put forth by the Griffith Foundation and NCOIL, including the upcoming conferences of NCOIL. So how do we use insurance? Insurance is used broadly as a way to pay for relatively large financial losses that might stem from a loss from our property, a loss due to some activity that we have engage in. It might stem from poor health or some other life event. Is used to meet requirements set forth by the government. So most states have some sort of requirement that mandates we have insurance or provides evidence of financial wherewithal to drive. Some or states oftentimes require certain employers to have workers' compensation insurance and provide coverage for those risks that their employers face. But it's also broader than that. Other contractual obligations, you can't buy a new car at least with a loan without having an insurance requirement. You can't take out a mortgage without facing an insurance requirement. And while these are oftentimes thought of, and we think of these as our activities that we do from a personal level, it's also true in a commercial in the commercial space. So many bonds and lending agreements require insurance purchases or might require some sort of bonding agreement that essentially says and guarantees the outcome or the ability for the lender to pay back their loan or perform some obligation. And to that end, insurance is used broadly for many investment sort of purposes. At the base level, insurance is relatively simple. We take a small amount of premium and we give that to an insurance company who will, according to the contract we sign, the policy that we buy, will pay for losses that will randomly occur. We'll point out that these premiums are certain payments, right? So we know that we're going to pay these premiums. And in exchange for that payment, if we have a large loss, if we had that random unfortunate outcome, the insurance company pays us for those losses. So in this way, the buyer of the insurance has reduced their risk, right? So they are no longer concerned about those unfortunate random large losses. And in exchange for that lack of worry, they have exchanged that for a guaranteed premium payment over the year, over many years. On the flip side of this, insurance company wants many of these buyers. So they take many of these buyers and are said to pool those risks together. Those risks then are said to be shared across the buyers of insurance. And ultimately then the insurance company is pooling those premiums, putting those many small premiums together and paying out, a few large losses to the policyholders, the members of the pool that unfortunately suffer the loss. We'll point out that the insurance mechanism itself may create risk. So it may encourage risk taking. It may discourage risk taking, and insurance companies are aware of this and try to have provisions and conditions in their policies to minimize, of course, excessive risk taking and encourage protection for certain parts of the policy. So can we buy insurance for everything? The answer is no, with a little bit of a wink. The people in the industry will tell you if you're willing to pay for a policy, someone's going to be willing to pay for it or willing to sell it to you. But in general, we do think of some characteristics of risk that are ideally insurable, if you prefer. So these are characteristics, these are risks that insurance companies find it very easy to insure. And ultimately what we mean by that is that the premiums that the insurance company will be able to charge or will be affordable to the buyer of the insurance. So what do those characteristics look like? Well, the first is what we think of as a pure risk. And that is that there's either a loss or no loss. So this is like a fire or a theft, where if it happens, you have a loss. If it doesn't happen, then nothing happens. So this is in contrast to speculative risk that we'll talk about in a moment. But here we just think of the situation of maybe we have a loss or maybe nothing happens. Ideally, we also want there to be a large number of exposures. So we want to be able to, if we think back one slide ago, we want to recall that we want to have a large pool, right? So the more exposures we have, the more people or the more businesses that have this type of risk, the more we can spread those risks out. Ideally, we want these risks to not be catastrophic. So we don't want the losses to occur all at once. If they occur all at once, this creates problems with the pooling mechanism. We'll talk about this briefly in a moment. Insurance is also usually referred, is thought of as best managing low frequency and high severity risk. So that is, they don't occur often, but when they do, they're relatively bad. And if you think about that from an individual perspective, we don't have a lot of car wrecks as individuals, but when we do, it can be very expensive. So those are the things that we would like to share with the risk pool. And lastly, we'll think of these ideal risk, insurable risk, as being risk that we can measure. So we want to be able to not only measure what the probability is going to be, but also determine if a loss occurs and how much was that loss. And if we can't do that, then it might be hard to set out the terms of the policy and to actually pay the policy ultimately. And so again, if we don't have, these are sort of the ideal characteristics. If they don't check all these boxes, that's okay, and you might still find some insurance. But the more of these characteristics the risk doesn't have, the more likely it's going to be harder to find insurance coverage. So what kind of risks do we see that are typically insured? Well, we oftentimes break this up into property liability risk and life and health risk. So property risk would be the loss of a piece of property that you might own, a house, a business, building, a car. I will point out that these property risks can have both direct losses and indirect losses, where direct loss is the loss of the property itself. So we have to repair our car or replace our damaged building. Whereas the indirect loss is the loss of the use of that property. So if we can't drive our car, we have to maybe take public transportation or get an Uber or have a rental car. If we can't, our business, if our restaurant has been destroyed by fire, not only do we have the direct damage that is to replace the building, but we also can't serve people in our restaurant. And so we lose that stream of income. Or we might have to find an alternative place to operate out of. Both of these would be considered an indirect loss to the property. And these are very important and easy to overlook, but very important. And we'll point out that you don't have to have actually have damage to have an indirect loss. So we don't have to look much further than the recent COVID pandemic to see situations where businesses may not have had a physical loss, but were were not able to operate at least normally, and suffered a lot of economic damages. We also have liability risks. These are risks or losses that stem from your actions, whether it's you as an individual or your business, any service you might provide or products that you sell. You're responsible for the outcomes of those products and those services. You're responsible for the outcome of driving and personal liabilities that you might have. We also think about life and health risks, that is the risk of dying too soon or dying too late if we outlive our savings. Those are very real risks that insurance oftentimes provides help for. And of course, health risks, whether it's surgery or an eye exam, these sorts of things can be insured, but are very real risks that we might have. And again, not surprisingly, there are many products for these general risks. Some of the risks, we've alluded to this a moment ago, that are not readily insured anyway, or hard to insure. Speculative risks, these are in contrast to the pure risks. These are risks where there is a possibility of a gain. So, any business risk, you open a restaurant, some people like your restaurant, some people don't, maybe a new restaurant opens up. These are all, standard business risks that are hard to insure because of their speculative nature. We mentioned catastrophic risk. Flood and earthquake are sort of the prime examples of these risks. These are situations where if there is a flood or is an earthquake, then a large part of your pool is going to have a loss. And this makes the pooling mechanism break down and can be very hard to solve. And in fact, the government oftentimes steps in on those two risks. And also other risks that you might be surprised to find, but if your homeowner's policy might limit your collection of antiques or limit your ability to collect on losses to antiques or hard to value property. And again, the situation here is not that it's particularly unique, but that it's hard to figure out what the actual loss might be. And finally, not surprisingly, insurers are reticent to insure losses that could be intentionally caused, and in fact have many conditions in the policies to prevent those losses from being covered. Well, while we will and will continue to talk about insurance, let's very briefly mention there are 3 other standard or primary risk management techniques that we might use for risk if we don't use insurance or in conjunction with insurance. So insurance, again, is very effective, as we've mentioned, for risks that are low frequency and high severity. But we'll briefly point out that insurance is not the only way to manage these risks. So any contractual transfer of risk can be efficient for these low frequency and high severity. Insurance is just sort of one mechanism. For risks that maybe don't look high frequency or low frequency, high severity, there are slightly more efficient ways to handle those. For those risks that happen a lot, that's high frequency but aren't that bad, we think of the appropriate measure, the technique here is loss control, where we're trying to minimize the frequency and sometimes the severity of the risk. We can think of this as an alarm system or anti-theft system in a department store. For those risks that happen often and with severe consequences, so high severity, high frequency, not surprisingly, perhaps the efficient way here that is thought of is to avoid the risk. Sometimes that's not possible. Sometimes you might find yourself in a medical malpractice, or as a doctor in an area where there's high medical malpractice costs and high jury verdicts. And if you want to practice medicine, then you might not be able to avoid it, but that might be an option. And the flip side of the high frequency, high severity is low frequency, low severity. Here, losses don't occur often, and when they do, they're not that bad. And not surprisingly, we will retain or pay for these ourselves. Moving back to the insurance mechanism itself, we'll think about how insurance companies price these risks. the basic idea is to figure out what the expected loss is going to be. So we want to know going forward, what is the loss that we think we're going to pay? And the way they do that is to look backwards and to examine historical losses. They might have a model that they can use to project the future losses based on historical losses. And the idea is the premium is meant to cover those losses. They're, of course, not only meant to cover the losses that they're going to pay, but also an allowance for the insurance company expenses and maybe other issues with respect to the uncertainty of the underlying uncertainty of the risk, and oftentimes, if it's a for-profit company, the profit of the insured. And we'll just sort of basically, we'll remind you that the basic idea here is that the premiums are taken before the losses occur, right? And so the insurance pricing is really important so that they're able to, insurance companies are able to pay for those uncertain losses with money that they collect up front. So the insurance pricing is, again, very important here. We've mentioned sort of some broad types of insurance, so let's just briefly turn to the common lines of insurance. These are roughly match up to some of the things we've talked about up to now. We think about those property liability risk as one line of insurance. Property liability here, very common policies that you've probably all seen, whether it's your auto policy, a business owner's policy, your homeowner's policy. There might be products liability policy, workers' compensation policies, a whole host. These are certainly not exhaustive list of insurance policies with respect to property liability lines of insurance. Likewise, in health and life and health lines, you think of life insurance, whether it's whole life, term life. Health insurance, of course, is very much in the news always in the U.S. Dental insurance, vision insurance, all these different lines, types of life and health insurance. Annuities, while not oftentimes referred to as insurance themselves, are also a sort of a type of insurance. Insurance is provided by a large, a lot of different types of insurance companies. Some are for-profit, some are not-for-profit. Mutual insurers are these not-for-profit insurers that are technically owned by policyholders. Governments, whether they be the state or the federal government, can also provide insurance. Crop insurance, flood insurance are standard federal government or popular federal government programs. State governments are, provide insurance to people that have a hard time getting the insurance. That might be an auto or homeowners or even for workers' comp. Those are called residual markets. And states also all provide unemployment insurance, and some have guarantee funds that will pay for the insurers if they go bankrupt. And then lastly, perhaps most important to you, regulation. Insurance again is regulated at the state level. There's a lot of different purposes of the regulation. We'll point out in general, the insurance regulators want the premiums to be not only too high and then have to worry about them being too high, but they also don't want them to be too low. So they want the insurance companies to be able to pay for losses if they have had the losses. And this all goes to the insurance company quality. So whether they're going to be insolvent or be able to pay claims if it occurs, how they're paying claims, what the policies are covering, et cetera. All things that an insurance regulator is going to want to oversee and to be aware of. And then finally, I'll leave you with a handful of current issues that are facing all insurance markets, whether it's climate change. You see states worry about insurers coming in and out of their state. Cost of insurance is something that's very important. And as in the news, inflation is driving some of those costs. New risks such as cyber risk, uncertainty about the risk are also driving some of these costs. A lot of issues. Insurance is, again, a very broad, big topic and can be very interesting. And with that, I'll thank you for your time and point you again to the NCOIL and Griffith programming, the upcoming meetings and otherwise, and wish you the best. Thank you.